Hi everyone, welcome to Value. So today we're going to look at TTCF. This is a company that seems to have popped on everyone's radar. They either think it's really good or seems to, been really bad. I think a lot of people did invest in it early on, and that was, a lot of people brought in at above $20, which, it's been a desecration of value in the recent times. So the biggest question is what's, happening with the company right now, and what's the real value, particularly in this current market, because last year markets were valuing everything at a high multiple, and with interest rates kind of rising, markets not really being too confident, the valuation of everything has come down in general. So we're going to look at TTCF and go, in general, is this company, was it worth that much at the time, and what's it worth right now? We're going to try to dive into the numbers and then try to figure that out. So they reported their fourth quarter revenues not too long ago. I think they reported in March, so about a couple of months ago. So their revenue at the time was up 32.2% to 52 million. That's for the fourth quarter. So in general, that would look quite nice. But if I compare it against the full year revenue, their revenue is actually up 43%. So fourth quarter actually dropped in growth percentages, which means they're probably not going to be growing as quick going forward as well. So in terms of their product mix, so they have their TTCF branded products, which is probably where they get their bigger margins, and it makes up 50% of their total revenue. And for the fourth quarter, they lost $13.1 million. So how does this compare with the full year? The full year they lost $87 million. So in general, they're losing quite a lot of money, particularly on the amount of revenue that they're bringing in, right? So if they're bringing in about 52 million and they're losing 13 million, that's not a great look. Firstly, in terms of the products that you do, you don't have large margins to begin with, and then now, basically, if you're losing money and growing slower, then basically it's going to be a tough climb upwards, because firstly you're looking at a situation where this is probably a good easy number to do. If you're earning 213 million for the year and losing 87 million, which is not quite half, but just less than half, which is insanely, kind of worrying at that stage. That either their spend is just too really large in terms of marketing and growing the company, or the costs are just having a mismatch between them pricing their products and the actual costs that they actually face. So in terms of EBITDA, that itself is 26 million negative. Usually EBITDA is the more positive one, but yeah, there doesn't seem to be that much positive in this one at all. Overall, if we look at the growth looks decent. But the thing is, if your growth can't actually make up for your expenses over time, then you're going to have to come back to the market to raise money, and it's going to continue to dilute your share price. So overall, if we look at the highlights, was they were in 160 retailers with approximately 14,000 locations, and that was up from 2020, which they only had 4 retailers and 4,000 locations. So you can kind of see that they are making some really good ground, but it could be at the expense of decent margins. So the biggest question is, would the company be able to get those margins back in the future when they manage to cement themselves? So yeah, I think that's kind of the problem. Like, if I just zip right down to basically their guidance, like there's a lot of numbers out here, but at the end of the day, firstly, we'll look at the financial condition. They've got 92 million in cash. So basically cash and cash equivalents, 92 million. So remember, they lost $87 million. So basically they have basically 12 months of money to just keep them going, which is okay. Like it means they will have to raise money probably 6 months down the track. Like I don't think they'll wait 12 months before they raise money, and I don't see them being cash flow positive in terms of the operations. So if we look at the Outlook generally provides kind of a decent look at the future of the company. So 2021 revenue was 213 million, and they're only going to grow to 280 million. So the growth is kind of slowing down a decent bit, but still overall, they're still growing about around that 30%, which is, still decent. But my worry is the growth margins here, which is 10 to 12%, which is kind of very common when you see it in food. So which makes the growth less impressive, because when you're growing quick, you hope that those margins eventually makes up for your losses. They are spending 27 to 32 million in marketing expenses. So we've got that kind of capital expenditure, and then we've got the capital expenditure of approximately 20 million, and that's for automation and robotics, which is good to improve the company as well. But my biggest worry is this company is going to run out of money in less than 12 months. So they're going to have to start raising money probably quite soon. 3 to 6 months would be the likely key timeline before they have to raise money, if they're a prudent company, because I don't think, unless their margins improve dramatically, their cost base is very, very high versus their margins, and they're also spending quite a lot on marketing. Like that's the thing as well. The products have to be marketed in order to find people to get people out there buying your products, which kind of is like you're going to have a lot of short-term pain, but you'll probably see it in the long-term gain, but overall, I'm not too sure it's even worth 651 million at this stage, because growth is okay, but the margins are worrying, and the fact that they'll have to raise money is also a worrying kind of situation. So you're facing a bit of uncertainty as well. Like even though they've given you the numbers, I think the company doesn't have like a strong foundation where their products, like if it was a software company and the margins were high, you might feel a bit more confident. But with this company, like firstly the marketing is great. Like I've followed them for a while, and the marketing is pretty decent. The product packaging is quite nice, but I don't think they're getting good enough margins, particularly when you try to get into large retailers. Large retailers don't generally give you much of a margin. You get okay margins, but they're not as good as they would need it to be, especially in their phase where they're spending a lot on growing the company. And particularly in this time, if we had a recession, and people, are having to cut back on their spending, then you would face a company that might have less demand in their products, because particularly with plant-based products, they tend to be more expensive than your common products, and people might buy them less as well. Also, with the current inflation rates, you'd be worried about this company being able to control its costs as well. So firstly, costs might increase more than they expected them to increase, and then also they're possibly they're most likely going to run out of cash within a certain time frame, within 12 months likely. So overall, like the company is decent, but I don't like the financial situation entirely. I think there's too much risk in the fact that if they run out of money, they're going to have to raise money, and if the share price is low, it's going to be dilution on dilution. In terms of like this company being at $20, like if we look at the financial metrics now, like back then they were growing quicker, and the problem with growth companies is the minute growth slows down, the valuation multiple comes down quite a lot, which is the kind of really big risky part about investing in growth companies, and particularly in this environment as well. So overall, like, if you don't own the company, I don't think it's recommended to be touched. Like, there's just not enough positives in general about the company. Like, yeah, it's in the right space. Like, don't get me wrong, it's in the right space. The product appeal is quite nice, but I don't like the financial guidance, particularly with them own. Overall they're growing okay. 280 million for the current year, for the next basically this year. But overall they're spending a lot on marketing. Their margins aren't high. So again, I don't think you miss out a lot on I don't think you really miss out on much if you don't buy into this company. I think there's a lot more better companies out there. I don't just it's not a company that strikes me with a lot of confidence. Not at this particular stage, not with these particular numbers. I think, when they were respect and they were listing, they look like a company with a lot of potential to be something quite great. But right now I just have to assess it on the numbers, and the numbers really don't match up as strongly. So I think you just want to invest in companies where the margins are clear. If you have high margins, then eventually it covers your losses. But if I do the projections for you and go, if they increase revenue by 30%, then it doesn't look like their margins are going to allow them to catch up, because like gross margins, say 280 million, and say 10%, that's $28 million for gross margins, and in their marketing expense itself is going to wipe them out in terms of the gross margins that they're earning. So immediately, just on the marketing costs, they're in a loss. Then they're going to spend on capital expenditure, which is 20 million, and remember, these guys only have $92 million. So then we're basically faced with a situation that goes, they're going to spend 20 million on robotics and automation, which is leaving them with 72 million. And last year, for 2021, they lost $87 million. So actually, when I think of the numbers now, I think they actually have less than 12 months of a runway, which is even more worrying. So I don't think it's something that's worth touching unless they probably raise more cash. If they raised another $100 million and the share price was lower, then particularly that might be a situation worth buying into. But at the current situation, it's not a good spot. Like, the company particularly could hit a point where the expenses go out of control, particularly this year with inflation. They run out of cash, the share price is low, and then they raise and dilute, and the chance of things turning out right is not on your side. So that's the kind of thing. It's a probability game. It's a situation you want to look at and go, is it favorable for you to buy the stock? And if you own the stock, it's a very difficult one to say, because if you own the stock, you obviously want it to do well, but I can't see the company being worth much more than it is right now, unless it gets a massive deal. Like, these things do happen as well, where the company might get a massive retailer deal where it goes into a lot of stores, a lot more stores than the current amount. But apart from that, or if they get a takeover offer, like if Beyond Meat or Impossible Foods decide, hey, we want to buy a company that's different from what they do, then Tattoo Chef would be the company. So if they got a really good takeover offer, that might also be something that boosts the stock price. But I think we're relying on a lot of unexpected things to happen rather than what we know so far. And from what we know so far, it doesn't paint the most rosiest picture right now. So if you don't own it, probably not worth owning it, to be honest. Like, you can look at the share price and go, it's dropped from $20 something to $7.90, and it looks like it might offer some good value. And potentially it might, but overall, on a probability basis, I don't think you turn it. I don't think it's as nice as it looks. It's particularly even though it's dropped so much, which is I'd like to be more positive about the company, because I think the products look kind of cool, and overall I like the industry that they're in. But they're certainly no beyond meat. They're not a product that looks like they're scaling quick enough and fast enough, that it looks appealing enough. So yeah, I think overall, particularly with the lower margins, it's a very difficult suggestion to say it's worth buying into, even though it's dropped so much. So what are your opinions? Do you think this is a company worth buying into? Do you own the stock? Looking at it now, it's not the best picture, but we all have our different perspectives, which is what separates everyone. Like in this market, there's always buyers at these prices, and there's always people with different views. I'm always happy to hear of those as well. But yeah, like my view currently is it doesn't appeal to me anyway. Not at this pricing, not with these financials, and that's usually what I go off. But yeah, until then, good luck investing, everyone.